Title of our webinar today is what CFOs need to know about go-to-market data now. And while the title is about go-to-market data and CFOs, it could have also been called something like emerging requirements for the strategic CFO. The CFO has always been responsible for reporting and compliance through the accounting function and forward planning and budgeting through the FP&A function. The difference now is that with the proliferation of recurring business models and the various forms that they take from subscription to consumption based, the revenue modeling and reporting requires today's CFO to reach deep into the go-to-market function in order to have a handle on how the business works. We're going to focus our time today on the go-to-market related reporting and modeling and analytics that you need to master as a strategic CFO in a SaaS or subscription world. And while it isn't rocket science, recurring business models are in fact more complex than traditional transactional models. And while much of what we're going to talk about will be contextually relevant to any business models, our focus today will be on some of the specifics, excuse me, involved with recurring business models. So before we get started, just a little bit about Scale Matters. If you can go to the next slide, Tim. So we've seen firsthand that businesses with really good data and analytics and models around their go-to-market function are able to deliver outsized growth and efficiency. And it's because they can operate at a level of precision and intentionality that companies without such a data posture just can't do. And from many years in the kind of VC and PE-backed ecosystem, we also recognize that most of the companies at these stages struggle mightily to get their go-to-market data house in order. And as a result, their leadership teams are really missing an important tool to drive efficient growth. We often like to say, your crummy CRM data isn't the reason you aren't growing fast, but it is the reason you struggle to figure out what steps to take to grow faster. So much expensive capital and precious runway is wasted by growth and mid-market companies because they just don't have the data to run their go-to-market function with precision. So we started Scale Matters 6 years ago to basically help companies transform their go-to-market data such that analytics can be performed and models can be built that legitimately help the leadership teams improve their outcomes. For most strategic CFOs, as well as PE or VC value creation partners, you are likely tasked to help professionalize operations to make them ready for an investment or an exit. What we're going to do today is try to give you a way of thinking about the kind of go-to-market data you will need to advance your operations. Given the constraints of time, we'll go fairly broad here rather than deep. There will be some model templates that we'll superficially touch on as well. But I think the point is, if any of you find this relevant, then at a minimum, we'll be happy to share the templates with you and where appropriate, meet with you to discuss the stuff in more detail. We're going to break this session into 3 parts. Part 1 will focus on reporting and compliance. In other words, the go-to-market data you will need to have to satisfy investor and board requirements. Part 2 will focus on value creation and specifically how to think about using go-to-market data to improve outcomes. And finally, part 3, we'll talk about an approach to basically identify the instrumentation that you will need to put in place in order to produce the necessary data that's described in parts 1 and 2. So let's jump into, next slide, Tim. The go-to-market aspects of financial reporting. For context, to think about reporting, let's remind ourselves of what drives value or valuation in these businesses. And there are really 4 things: scale, basically how big your business is. 2, expected growth rate. 3, the expected capital efficiency. And 4, the kind of perceived risk of execution that an investor might think about your company. And these are the things that you need to be able to report on to your board and investors. And you're going to need data to do that. So now let's take a look at, we like to think about the data. Next slide, Tim. We like to think about the data by mirroring it against the growth model. In particular, in this case, we're looking at the subscription growth model. And let's think about those 4 things we talked about: scale, expected growth, expected efficiency, and execution risk. The measurement of scale in the SaaS world is annual recurring revenue, or ARR. This is basically the sum of the ARR across all of your customers. And for each customer, the ARR is essentially 12 times the monthly recurring revenue, or MRR. One of the interesting things about these SaaS metrics is that they aren't yet governed by something like GAAP. So there is often some variation and nuance in the way these things get reported. And so I'd encourage you guys, whenever you're reporting on this stuff, to be very transparent on exactly how you're calculating it. Anyway, so ARR is the indicator of scale, which is the first consideration that affects value. The second value driver is expected growth rate. And to better understand that, let's continue to build out the SaaS growth model. First, we add to the current ARR the amount of ARR we expect to get from new customers, aka new logos in SaaS parlance. Next, we deduct from that any ARR that we expect to lose from our current customer base due to them churning or shrinking the size of their contractual obligation with us. And that would normally happen, not always, but normally happen at the time that their contract was up for renewal. Finally, and conversely, we add in or add back any ARR that we expect to gain from our current customer base due to expansions or upsells or cross-sells. And the ending result of these components is the future ARR. So the sum of new logo, reductions, and expansions constitutes what I'll call net growth for a period. And the net growth divided by the current or beginning ARR is the growth rate. So now we have scale, which you can report on, which is ARR, and you have growth rate, which is the net growth divided by current or beginning ARR. I should mention this model would change a little bit if it was a consumption model, or if new logo was maybe primarily driven through a partnership motion. So it is important to understand your basic motion and model that appropriately. So we've knocked off scale, we've knocked off growth rate. When it comes to, we're going to go to efficiency now. When it comes to efficiency, there are a number of financial metrics that you guys all know of that help to form a narrative around a company's capital efficiency, such as EBITDA, return on invested capital, revenue per employee, et cetera. But specifically within go-to-market, we believe there are 2 things you need to have a good handle on. First is customer profitability. In other words, what is the contribution margin that each customer provides to fund G&A and R&D, and then hopefully have something left over for profitability? Are these customers even really worth having? In the SaaS world, we use the ratio of LTV to CAC, lifetime value divided by customer acquisition cost, as the primary measure of customer profitability or unit economics. The second thing you need a good handle on is how much cash you must consume in order to grow at the desired rates. In non-recurring models, the faster you add customers, the more cash you generate typically, provided you have some gross margin. Unfortunately, this is not typically the case in recurring models. In these cases, since you are spending up front to acquire the customer, but you're deferring the revenue over time, the faster you add customers, typically the more cash you consume. That could be moderated a little bit by what your billing frequency is. But in any case, so the amount of cash you burn is largely determined by what we call CAC, or measured by what we call CAC, which stands for customer acquisition costs. And from the prior slide, you can think of this as the investment that produces the net growth. Now, in order to have a good handle on customer profitability and cash consumptiveness, you really only need two things. First is a reliable and sufficiently granular model for CAC, customer acquisition costs. And by sufficiently granular, I mean a model that can be sliced by channel and by segment, such as industry vertical or some other ICP profile characteristics. You must understand which channels and which segments are efficient for acquiring revenue and which are not, right? So that you can sort of double down on the efficient ones and jettison the less efficient ones. In order to create a useful CAC model, you'll first need to have defensible models for how you attribute cost. And then you will also need full funnel analytics, which clearly shows the dynamics of how a lead converts through the selling process to eventually become a customer. By the way, there are a couple different ways to talk about CAC. I generally think about it as how much do I need to spend to get $1 of new ARR, or alternatively recurring gross profit. To be precise, this is probably what's really known as CAC ratio. Others like to talk about CAC payback, which is sort of how many months does it take to recover the acquisition costs. And again, that's most legitimate if you think of it in terms of how many months of gross margin does it take for me to recover the customer acquisition cost. Which you use really doesn't matter. What does matter is that with any of these metrics is that you're, again, fully transparent on how you're deriving them. The second model you'll need is a reliable and sufficiently granular lifetime value model, LTV model. And there are two components to that, really. First, and the core of it is just a model of historical gross profit by customer, as well as a model of historical recognized revenue by customer that's used to determine retention and churn metrics. Now we're going to switch just for a second, and I'll show you one of these models that we use so you have a little bit more idea what I'm talking about. I'll share screen. Okay, so this is a template that we use for LTV and CAC, and you'll notice that there's 4 tabs here around lifetime value, and there's 2 or 3, two around CAC. So the very first thing on the LTV template is to just capture the historical recognized MRR by month for each of your customers. And that's what this is in this template. We've got, I don't know, 70 or 79 customers, and based on the revenue that we recognize for them each month. And you can see, like this customer here, customer 6 started with us in March of 2019, didn't last that long, and they were gone by September of 19. And so the table ends up looking something like this. You'll notice a couple other features is that we identify the start month when a customer first joined us, the start quarter. And then in this template, we're using 3 fake profile characteristics. One attribute is a size attribute, one is a color attribute, and one is a geo attribute. And we'll come back later to why we do that. Anyway, the very first step is to capture all that information. From that, the template actually calculates monthly and yearly retention metrics: logo retention, gross dollar retention, net dollar retention. The next step on lifetime value is to understand your margins. And here we have just plugged in what the gross margins are for each of the types of customers based on those profile attributes. Hopefully you have a methodology for attributing COGS against different types of customers, which will allow you to understand different margin profiles. The third step is calculating, basically taking the first step and then filtering it by different profile characteristics, so that we're calculating for all the big customers that had that profile, calculating the retention metrics for them, and so on down for each of the various ICP profiles. So then the last thing is we calculate the lifetime value. And the lifetime value is basically the average gross profit divided by the churn. And so we end up with this table of lifetime value by different types of customers. So that's the LTV side. CAC, we start with full funnel analytics. So what is the conversion rate through every step of your process, from leads to first meetings to opportunities, through the various stages of opportunities? How long does that take, et cetera? We have that for each of the different profile characteristics. We also then have a cost attribution methodology that we use, which basically attributes the sales costs, et cetera. So you'll need to be able to attribute sales and marketing costs on a channel or template or segment basis, which allows us then to calculate. And again, you're not going to understand this at the speed I'm going through it right now, but it allows us to calculate the CAC both on a cost per deal and a cost per dollar of ARR basis for these various profiles. So once we have LTV and once we have CAC, we just summarize what the LTV to CAC is. So we understand in this example, the customers with the green profile are our most profitable customers, if you will. Okay, so let's go back. And again, we can send this template out to any of you that are interested. Tim, let's pop back in. I'll stop sharing. If I can figure out how to do that. Stop sharing. Okay. And let's go back into the, so part two. So we've talked about reporting for governance, et cetera. Now let's talk about value creation. We've talked about the metrics you need for reporting. When we talk about value creation, we're talking specifically about the data that you need to help make decisions that are going to improve outcomes. So we believe that before you can seriously begin to understand what levers you can push to improve outcomes, you first have to be able to model your go-to-market function at a sufficient level of detail, what we and others would call a growth model. Here again, we're using the visual of the subscription growth model, but we've added in another level of detail here, which represents the process of acquiring new customers, what we call the new logo funnel process. And in essence, you start with some number of leads that hopefully match your ideal customer profile. You put them through a sales process, i.e. a funnel, and some number of them come out of the other end of the process as new customers or deals at some average ARR, therefore yielding a total new logo ARR. A good growth model is based on historical performance, and it very clearly draws the connection between historical performance and expected future performance. I'm now going to pop to another model template that we use, which is a growth model. I'll be very quick on that. Okay, growth model. So basically the growth model, it has three parts. These green tabs are all around the new logo model. So there's instructions on the first tab. And what we basically do is we build up a funnel model for each channel. Like here, we're in the blue, we're looking at paid search funnel, and you see all these different conversion ratios from every step, right? Web sessions into leads, leads into the initial meeting set, etc. That is all based on historical data. So if you're going to build a good growth model, you have to have good historical funnel analytics. So here you see the historical, these other tabs, which I won't go into now, sort of talk about how the math is done to project out the future stuff. And then the new logo assumptions tab lets you change assumptions and do some scenario modeling. So the first part of this is to build up, what does our new logo acquisition look like over the next 12 to 24 months? Then the purple or lavender or whatever color these are all around existing business. And we start with a lot of that stuff we just showed you on the LTV slide so that we can calculate retention for the existing business. And then finally, what we do is we aggregate the two, which shows us number of customers expected going forward and amount of dollars expected going forward from our current client base based on historical retention and churn dynamics. And then the recognized revenue expected from each monthly cohort of new logos. So you end up with a very detailed sort of bottoms up growth plan. That's what a good growth plan looks like. Most companies don't put the effort forth to make that happen, which is a miss for them. So back to value creation. Remembering that value creation means taking actions that improve outcomes. We find it constructive to stick with this growth model, right? And to understand what actions you could possibly take. The first action you can take is to actually drive an increase in the number of leads entering the new logo funnel that actually match your ICP. You know, we talked in a previous webinar about how to use go-to-market data and LTV to CAC to actually identify your ICP. If you missed that, you can find a recorded version on our website. The second action you can take is to balance your resource capacity across the top, middle, and bottom of funnel. What does this mean exactly? It means you should make sure that the number of salespeople and or SDRs you have is appropriate to the amount of ICP leads that you can generate. In the majority of companies we see, they have too many salespeople without enough top of funnel support. Third thing that they can do, that you can do to increase growth is to increase conversion rates throughout the new logo funnel. And this tends to be a very big focus of what we do with our customers, helping them get the data to help to do that, assuming that they're driving some high quality leads. You can potentially take actions that increase your average deal size. You can also take actions that reduce churn and downsell. And finally, you can take actions that could increase upsell, cross-sell, and expansions. So then the question is, what do you need to know to inform you to take which actions to affect these various levers? And that's where this we have a thing called Data Drives Action framework that I'll walk you through a little bit. But it's very prescriptive in defining the questions you need to be able to answer in order to inform you on what actions to take. So, for example, let's take that first value creation lever, which is increasing the number of ICP leads that you're generating. There are some very specific questions you have to be able to answer in order to do this effectively. You first need to understand what your ICP is. By understanding the ROI on a segment or profile basis. Again, we've previously done a webinar dedicated to that. You can go look it up on the website. Secondly, you need to know the relative ROI of your channels and or campaigns. And that's very different than cost per lead by channel, right? Because leads aren't the end goal. Sustained high margin revenue is the goal. So you need to understand on a channel level, which channel produces the most sustained high margin revenue per dollar invested. So you can put more money towards that channel and take it away from the ones that don't. And you need to understand which channels are the most scalable because a high ROI channel isn't real helpful if you can't invest in it without getting diminishing returns. point here is that on any one of these levers, you need to answer the precisely right questions, because answering the wrong question will likely lead to actions that are unproductive, or worse, they're counterproductive. Tim, I think we'll skip the next 2 slides, actually 3 slides. Well, this slide's fine. Again, so if you take that growth model and the 6 levers that you can push, then for each of those levers, what you need to do is nail the right questions, right? Because if you do, it'll become obvious. If you can answer the right questions, it actually becomes obvious what actions to take. And we've got a bunch of these questions built out. If you're interested, reach out to us and we can sort of walk you through them. But we don't have time to go through the whole thing today. So last part, we spent a lot of time talking about how to use go-to-market data for reporting and compliance use cases, as well as how to inform value creation activities, with all of this framed in the context of the valuation drivers and the growth model. So now let's talk about what instrumentation you actually need to produce the required data. And getting the data right in support of these metrics and analytics tends to be the hardest part of this stuff. Is part of the reason that most growth stage companies, part of the reason for this is most growth stage companies don't have any one person responsible for it. So the concept of data operations is often sort of superficial. Anyway, by and large, one, they never set up their CRM and other go-to-market tech stack to provide the necessary instrumentation. This is sort of the prevailing stuff that we see out here. 2, the data is often stuck in silos, all kinds of data hygiene issues with it. 3, while they have a lot of reports and dashboards, they just aren't designed in a way that's actionable. So people look at this stuff and then just eyes glaze over. The end result of all this, most of these companies are operating on gut and intuition, because they really don't have the supporting data to inform highly precise actions. So now let's look at another approach to all this. And this is how we would encourage you to think about getting your data house in order. 1, start with the actions, right? Think about all the actions you could take. In the example I gave you, those 6 levers, right? The various levers you can push on. Then we say, okay, what do we need to know that would inform us to take one set of actions versus another? And this is what we call insights. And insights are really just answers to a very precise set of questions. So we know that being able to answer the right questions will inform the actions. Armed with the precise questions that we must answer, we can then identify what data is needed, how should it be presented, in order to efficiently answer these questions. And once you've determined the data and the way it should be presented, it's really straightforward to identify sort of how you need to configure your tech, what processes need to be implemented in order to produce the data. So I'll give you one example of sort of how this works. Now, Tim, just stay on the slides. We'll go to the next slide. Yeah, so that first value creation lever, right, set of actions. One of the questions is, what is the relative ROI of our segments, right? Which is what you need to know to really know what your ICP is. If we go to the next slide, we answer that question by understanding the relative LTV to CAC ratio for each customer profile. The stuff we've already gone through, I went through the LTV and the CAC model. Understanding relative LTV to CAC ratio by customer profile identifies who your ICP is. So as you can see here, if you start with these actions, reduce them to questions you need to answer to inform the actions you will take, then that will tell you what data you need to have. So let's just go to the last slide, or the foundational data. Yeah, that one. So at the top level, there's really 3 fundamental components that you're going to have to provide the data to answer the questions that you're going to need to answer. You are going to need to have methods of attributing costs so that you can calculate various ROIs and SaaS metrics such as CAC. You will need high confidence full funnel conversion analytics to inform your models, um, and as well as to identify where there's stuff breaking down, right? And you're going to need accurate revenue recognition data. Talking to a company recently that was looking at doing the retention stuff, and they're doing it on a cash basis, and it's not really going to work, right? Because unless you bill everybody on a monthly basis, so you have to do accrual-based accounting. You have to have accurate revenue recognition data, because that's what will help you understand your retention dynamics. And for all of this stuff, you need to be able to slice it by the various dimensions, whether it's channel or segment or geography or whatever. So that's the end of our pitch. I know we threw a lot at you today. Happy to share the models, but again, think of it as there's three different things you got to think about: reporting and compliance. You got to report on scale, growth, expected efficiency. You have to. The big win in data is when you leverage it for value creation. So you have to be able to produce a growth model, and then identify these various levers that you can push to improve outcomes. And you do that by being able to answer very specific questions. And then that sort of is the genesis of the data and the instrumentation you're going to need to put in place.